Hi there. In this video, we'll explain the £30,000 and £20,000 thresholds and how MTD ITSA affects landlords.
Hello and welcome. On behalf of the team here at My Tax Accountant, or MTA for short, I am absolutely thrilled to guide you through this explainer. Today, we're unpacking what is genuinely one of the biggest shakeups to UK tax in a generation. We're talking about making tax digital for income tax self-assessment, or MTD ITSA. More specifically, we're zooming in on the phasing for UK landlords. We'll be looking at the £30,000 threshold and taking a really close look at the massive £20,000 rollout hitting us in 2028. If you're a UK landlord managing, say, 1 to 3 rental properties, listen up, because this is going to fundamentally change exactly how you interact with HMRC. So let's jump straight in.
I want to kick things off with a quick, totally relatable, real-life scenario. Meet John. John is a very typical UK landlord, and honestly, his situation might sound a lot like yours. He's got a couple of rental properties, and together they bring in £22,000 a year in rent. But of course, John has mortgages on those properties. He pays letting agent fees, he's got landlord insurance to cover, and, he's constantly dealing with those inevitable property repairs. So by the end of the tax year, his actual net profit, the actual cash landing in his pocket, is only £4,000. Now, John's been hearing the buzz about making tax digital and this new £20,000 threshold. He does the maths and logically thinks, well, my profit is only £4,000, so I'm well under the radar. This doesn't apply to me, right? Well, actually, he is completely wrong.
And this brilliantly illustrates what we at My Tax Accountant called the gross income trap. John is literally caught right in it. You see, HMRC doesn't test your eligibility for making tax digital based on your net profit. They don't care what's left over at the end. They test it on your gross income. And gross income is simply the total rent you've collected before any expenses are deducted whatsoever. Because John's gross rent is £22,000, he is sitting directly in the crosshairs for the 2028 mandate. He's absolutely going to have to comply with quarterly digital reporting, even though his actual take-home profit is incredibly small.
So here is our roadmap for today. We'll start by breaking down the gross income trap. Then, we'll look at the MTTSA phasing timeline. After that, we're calculating qualifying income, looking at the specific rules for joint owners, diving into the quarterly reporting cycle, and finally, wrapping up with your next steps with MTA.
Section 1. The gross income trap. Understanding the true threshold.
So what exactly is gross qualifying income? Basically, it's the combined total of your gross rental receipts and your self-employment turnover before absolutely any allowable expenses are deducted. I really want to emphasize this because it is hands down the single most common misunderstanding among landlords. Standard deductions, like those letting agent fees that are taken out before the rent even hits your bank account, your property insurance, or say that hugely expensive emergency boiler repair you had to pay for last winter, none of those lower your threshold for the MTD test. If your tenants pay a total of £25,000 a year over the course of 12 months, your qualifying income is £25,000, period. Your expenses only come into play way later when calculating the actual tax owed, not when determining if you're mandated into the digital system.
Now, did you know the £20,000 threshold taking effect in 2028 is going to sweep an estimated 700,000 to 800,000 newly mandated taxpayers into digital reporting? I mean, that is just a staggering statistic. It proves that this isn't just a rule designed for massive property tycoons with multi-million-pound portfolios. No, this expansion affects almost everyone in the property sector. In fact, this Phase 3 cohort absolutely dwarfs all the previous phases combined. It is bringing the entire long tail of mid-tier landlords, accidental landlords, and small operators straight into the digital tax net. And frankly, many of these folks have never used accounting software in their lives.
Section 2. MTD ITSA phasing timeline, 2026 to 2028.
Let's look at the phased rollout directly from HMRC. Phase 1 kicks off in April 2026, and that catches anyone with a gross qualifying income over £50,000. Phase 2 drops that threshold to £30,000 starting in April 2027, and then we get to Phase 3. This is the massive expansion in April 2028, where the threshold drops all the way down to just £20,000. If you are a UK landlord managing 1 to 3 properties, Phase 3 is almost certainly where you are going to be caught. Even with modest rental yields across just 2 properties, you will quickly breach that £20,000 annual mark.
But here is the absolutely crucial catch. You might be wondering, how does HMRC actually know if you hit that £20,000 mark for the 2028 rollout? Well, they use what's called a determining return. For the April 2028 rollout, HMRC is going to look all the way back at the 2026-27 tax return that you'll file in January 2028. That specific historical return locks in your Phase 3 status. So think about that. The financial moves you make, the rents you charge, and the income you generate in the 26-27 tax year are the exact numbers that will dictate if you're forced into quarterly digital reporting. You simply cannot wait until 2028 to start planning, because the die will have already been cast by your prior year earnings.
Section 3. Calculating qualifying income, cross-stream aggregation.
Okay, let's see how this maths actually works in practice, particularly for those of you with multiple income streams. Say you've got a small sole trader business. Maybe you do some freelance consulting, or you run a small online shop, and you're earning £15,000 gross. Now, in addition to that, you rent out a small flat that brings in £8,000 gross. You might look at those two businesses individually and think, well, 15 and 8, neither of those is over £20,000 on its own, so I am completely fine. But that's not how it works. HMRC aggregates them together. £15,000 plus £8,000 equals a total qualifying income of £23,000. And just like that, because of a side hustle, this small landlord is pushed directly into the 2028 mandate for all of their self-assessed income.
Now, before you hit the panic button, let's look at what is safely excluded. If you have a primary day job, your PAE employment salary does not count towards this threshold at all. The same goes for pension income, dividends you extract from limited companies, savings interest from your bank, and capital gains from selling a property. These are all entirely excluded from the calculation. This should provide some immense relief. To put it into perspective, if you're a high earner pulling in £80,000 a year in your corporate day job, but you only generate £10,000 in gross rent from a single investment property, your qualifying income for MTD is just that £10,000. You would be totally safe from the mandate, completely unaffected by your high PAE salary. Section 4. Rules for joint owners. Navigating co-ownership.
Making tax digital is assessed on your individual share of a property, not the property as a whole. So if a property generates $40,000 a year and you own it equally with your spouse, you each have a qualifying income of exactly $20,000. Simple enough? However, while 50-50 is the default assumption for married couples and civil partners, you can absolutely use strategic planning here. If you own the underlying property in unequal shares, you can actually make a Form 17 election to HMRC. This allows you to split the income unevenly for tax purposes, say 60-40 or even 70-30, reflecting the true beneficial ownership. Taking the time to structure this properly right now could actually keep one partner entirely below the $20,000 MTD threshold, effectively delaying their entry into the digital system and saving a massive amount of admin.
And here is a fantastic professional tip straight from our experts here at My Tax Accountants. Once you're actually in the MTD system, having to report joint expenses every 3 months can be an absolute nightmare. Imagine splitting receipts and dividing tiny invoices with your co-owner 4 times a year. Thankfully, HMRC has introduced something called Easement 2, specifically for jointly owned properties. This is a brilliant rule. It allows you to submit your quarterly digital updates containing only your gross rental income. That's it. You can entirely defer all those complex fiddly expense splits and calculations until your final end-of-year declaration. Leveraging this easement drastically reduces your administrative headaches every quarter. It genuinely turns a potentially painful workflow into a highly manageable one.
Section 5. The quarterly reporting cycle, your new workflow.
The traditional system of filing one big annual tax return in January is going away for your property and sole trader income. It's being replaced by a strict 5-step process. You're going to need to submit a digital update using approved compatible software by the 7th of August, the 7th of November, the 7th of February, and the 7th of May. Now, it's important to note these are not full tax returns. Take a breath. They are simply summaries of your income and expenses for that specific quarter. Then, step 5 is your final declaration. This remains due by the 31st of January the following year, and this is where everything comes together. You claim your reliefs, add your PAY income, make any accounting adjustments, and finally settle your actual tax bill.
But you really need to stay on top of this because HMRC is introducing a strict Schedule 55 penalty point system to enforce this new quarterly rhythm. Under the old system, a late return just meant an immediate fine. Now, it's a points system. If you miss a quarterly reporting deadline, you receive a penalty point. Miss a second deadline, that's 2 points. Miss a third, 3 points. But if you hit 4 points, representing 4 missed or late quarterly updates, it triggers an automatic £200 financial penalty. And crucially, once you hit that threshold, every single subsequent failure triggers another £200 fine until you demonstrate a long, unbroken period of perfect compliance. You simply cannot afford to ignore these new, highly regimented quarterly deadlines.
Section 6. Next steps with MTA, surviving the transition.
So where do we go from here? Well, you currently have an 18 to 24 month planning runway before the major rules really bite.
Here is exactly how My Tax Accountant helps you use that time effectively. First, we comprehensively assess your 2026/27 determining return to see exactly where you sit against those gross thresholds. No guesswork. Second, we set you up with HMRC compatible software because you simply cannot use paper records or basic spreadsheets anymore. Third, and this is absolutely vital, we configure your Agent Services Account or ASA. Those legacy paper 64-8 authorizations that your accountant used to rely on, they will not work for MTD. You need proper digital ASA authorization linking you to us. And finally, we handle the heavy lifting. We file your quarterly updates flawlessly so you never accrue a single penalty point.
I want to leave you with this question to ponder. Are you caught in the gross income trap without even realizing it? Really think back to John from our earlier scenario. Please do not let your low net profit lull you into a false sense of security. You absolutely must check your gross numbers immediately, especially before the critical 2026/27 baseline year comes to a close. Early preparation is quite literally the only way to ensure this transition doesn't disrupt your property business.
Do not try to navigate this complex transition alone. The move to digital reporting is entirely manageable, but only with the right professional preparation. Reach out and contact My Tax Accountant today. You can give us a call on 0208-570-8531, drop us an email at info@mytaxaccountant.co.uk, or visit our website at www.mytaxaccountant.co.uk for step-by-step assistance. And hey, if you found this explainer helpful, please make sure to subscribe to our YouTube channel for more critical updates as these MTD rules continue to evolve.
Thank you so much for joining me today. Just as a quick reminder, this explainer is for informational purposes and does not constitute formal tax advice, as UK tax legislation is always subject to change. Please reach out directly to the team at My Tax Accountant for professional guidance specific to your unique circumstances and your personal property portfolio. Thanks for tuning in and stay ahead of the curve.